So it looks like Trump's tariff inflation is finally here. And unfortunately, it's hitting the PPI first. This is the producer price index. This is widely regarded as a leading indicator to the CPI, the consumer price index. So today, a report came out, the most recent PPI report, and the numbers are pretty bad. So, headline PPI inflation. So, this would be similar to headline CPI inflation. This came in at 0.9% as opposed to an estimated increase of 0.2%. So, massively higher. And then if you do core PPI, that came in again at 0.9%, 0.9%, as opposed to an estimated 0.3%. So significantly higher. Now, on the core metric, this is the highest number since March of 2022. And on the headline metric, this is the largest number since June of 2022. And even if you remove volatile assets, so this would be the core PPI of food and energy prices and trade services. So adding one more thing, it still came in at 0.6% higher. So what does this mean? Well, it means that inflation, tariff inflation, is finally starting to show itself. People have been wondering, where the hell is tariff inflation, right? CPI, yes, it's ticked up a little bit on the last report, but nothing crazy. Well, the PPI, Producer Price Index, that's exactly what it sounds like. This is the prices that businesses have to pay, which means that there is a push cost price increase from inflation. And really it becomes a question of, can these businesses eat the cost? Do they want to eat the cost? Will they eat the cost, or will it be passed on to consumers? Because if this PPI, which is widely regarded as a leading indicator to CPI, if these companies cannot eat the cost, it's going to show up in the CPI, the Consumer Price Index. Now, here's just a little bit of, a news flash. I'm sure most people have come to this conclusion. Most of these companies don't want to eat this added cost. But more importantly, a lot of the companies that you and I buy from on a daily basis, Walmart, Amazon, Target, basically your big retailers who sell a ton of stuff that we use on a day-to-day basis, they are operating on a massively razor-thin profit margin. And I know people think like Walmart, it's a massive company, right? They must be making tons of money. They're making tons of money. But their profit margin is like 2%. It's like 2.5% last time I checked. It is razor thin. So when you have PPI, the producer price index for inflation increasing at 1%, that's going to be very difficult to eat that cost. Another thing that I want to stress, I cannot stress this enough, because a lot of people, you got to realize economics is like a web, okay? And if you cut something here or you move this part of the web, it's going to have a ripple effect to the rest of the web, or it's like a pond, right? You throw a rock in here, you're going to have ripples everywhere else, and that's what you have to understand. So even if we're screaming, even if the companies can absorb the cost, right? Even if companies can eat the cost, and we, the consumer, we say, screw them, let them eat the cost, right? The problem is most of these companies are publicly traded, which means that most Americans' retirement accounts in some way, shape, or form are tied to these companies. So they either pass the cost on to consumers and we get screwed, or they eat the cost, their profit margins go down, their stock prices suffer, and people who are literally trying to retire at some point, which is everybody, they also get affected. And yes, of course, it affects the CEOs, the 1%, the 0.1% more, but the average American is going to feel it regardless. And this is all avoidable. And that is what bothers me the most, is that these things were entirely avoidable. A lot of this PPI inflation, and there's going to be studies and data done on this, you're going to be able to directly trace it to Trump's tariff policies. This was completely avoidable. Now, again, the next big question, and the one that matters to you, will it show up in the CPI? Because that's the one that you feel, and when? Well, it is a leading indicator to the CPI, which means the next month's CPI inflation report is going to be vital. And it's also going to be vital for the Federal Reserve, because remember, the Federal Reserve kept their interest rates steady. Then they got a horrible jobs report. Okay, and then people were saying, oh no, we got bad jobs, inflation is still here. Is stagflation on its way? I've said, hey, we're the closest we've been to stagflation in a long time. And then, oh, the CPI inflation report came out, and look at that. Rosy, great, fantastic, everything's fine. Maybe we will avoid stagflation because now the Federal Reserve can cut their interest rates at their next meeting and all will be fine and dandy. And now we got the PPI inflation report, which isn't as highly looked at by the average person, although finance professionals do look at this number, and the Federal Reserve definitely looks at this number. But it's not as known as the Consumer Price Index or the PCE index, but it is still important. And it's massively important because it is a leading indicator. So this coming month's CPI inflation report is going to matter significantly because we will start to see if this PPI bleeds over to the CPI. Okay? And on top of that, the Federal Reserve is going to want to really, really look at this next CPI report when it comes to future policy decisions. Now, when you look at the CME Fed Watch tool, okay, I highly recommend everybody track this, look at it. It's important, and it gives you a good idea of where the odds are for an FFR cut, a federal funds rate cut. Right now, the odds are very high that the Federal Reserve will cut the next meeting. Okay, after this report was released, those odds changed. They didn't change drastically, but they are a few percentage points lower when it comes to a likely change than they were before. Okay, and that is because this is the data that the Federal Reserve relies on, and unfortunately, now I have to say it again. I had just, we had just got the previous inflation report. Things looked good, and it's like, oh, maybe we avoided stagflation. Okay, I have to say it again. I have to remind you again that we are trending towards stagflation. It doesn't mean that we're there. It doesn't mean that it'll ever come. Stagflation is very rare. Okay, for those of you that need a little refresher, stagflation is exactly what the name is. Inflation, hence half of the word, and stagnation in the economy. That means bad jobs numbers as well as bad GDP or economic growth. So the jobs report was not great. There's a good chance that even the most recent jobs report will be revised downward, just like the two previous months were. And on top of that, now you have PPI inflation accelerating way more than expectations. More than 0.5% higher than expectations. More than the number doubled than expectations. Okay, so the next CPI inflation report is going to matter. It's going to matter for your wallet, and more importantly, it's going to matter for the Federal Reserve. I don't want to say more importantly. Your wallet is important. But just as importantly, it's going to matter for the Federal Reserve when it comes to making that policy change. Because remember, they are right now, yesterday I would have said, hey, their job's easy. Bad jobs number, good inflation number, cut rates. Well, now you got PPI, which is a leading indicator to CPI, blowing it out the water, very clearly signifying that tariffs are on their way. Tariff inflation is on its way, and it's going to show up. It's going to show up. And Trump has been, not going to happen. A lot of people have said, who support Trump, not going to happen. Where is it, etc. And then you had people on the other side saying, hey, it's going to happen. And then you had professional economists and finance professionals basically saying it is a logical conclusion, whether you like Trump or not. It is a logical conclusion that when you increase the costs of goods through basically a cost that has to be paid, which is inflation, tariffs, you're going to get inflation on the CPI because companies either cannot absorb it or they will not absorb it. And even if they did, then the stock market takes a hit. So we're screwed either way. We're screwed either way. If it shows up, we're going to be screwed in our retirement accounts, or we're going to be screwed in our wallets through the CPI, or it's going to be both because companies are going to have to raise prices and their stock market or their stock prices are going to suffer because they're going to sell less goods because people can't afford it because right now the jobs market is bad, which is exactly stagflation. So are we close to stagflation? Yes. Is the Federal Reserve, did their job just get significantly higher from yesterday or harder from yesterday? Yeah, it did. Because now the decision is not in September on their September meeting. It's not as simple anymore. It's not, great job or bad jobs numbers, great inflation numbers, cut rates. Now it's terrible jobs numbers, which may be revised again, And you have this, I almost see PPI as a cloud, right? You have a cloud in the horizon, a dark, just thundering storm cloud in the horizon. It's sunny where we're sitting here on the beach, right? Drinking our pina coladas. But in the distance, you have this storm cloud, which is PPI. And now you have Jerome Powell, who's sitting right next to me, sipping his, margarita, pina colada, whatever he drinks, looking at that storm cloud saying, we might have to wait to cut interest rates because that's on the horizon. And we need to deal with inflation before we deal with the jobs market, which even after the last report, unemployment is still low. I hate to say the Federal Reserve doesn't care about your job, but they don't care about your job or my job or anybody's job, right? They care about balancing inflation and employment. And if they can tick up the unemployment rate 0.5%, another percent, and it can still be relatively low, 4.5, 4.6, 4.7, 4.8% unemployment, they might do that. They might do that if they think that inflation is the larger or more ominous threat. We'll have to wait and see for the September meeting, and we'll have to see when the next CPI inflation report comes out, the next PCE inflation report, and we'll have to see if this starts to bleed into it. Remember, it might not bleed into it in the next one. It might take a couple CPI inflation reports for PPI to bleed in, but it's very likely that it will. I will keep you up to date as best as I can when it comes to this stuff. I love finance and economics. It is my background. I usually say it at the beginning of my videos. I didn't this time. My name is Derek. I got my degree in finance, so you don't have to. I love this stuff. I've been doing this for over a decade. If this video was informative, please consider subscribing if you haven't already. It's hard to grow on YouTube, so every subscription matters to me. I thank you guys tremendously. It doesn't cost you anything and it helps the channel grow, and it means the world to me. With that said, I hope you have a fantastic rest of your day, even with this report looming out there, and I hope to see you around for the next one. Until then, take care.